In this video, we are going to cover cost classification. So by now, I'm hoping that perhaps you are familiar with what is in the income statement. And I've included here a quick overview of the line items, working our way down from sales at the top, also using some different terminology in turnover and revenue. From that, we subtracted the cost of goods sold, or maybe we called it cost of sales, in order to attain a gross profit. We've paid some expenses, and the specific expense we've called depreciation in order to get the operating profit. We then paid some interest expenses. Maybe we received some interest income before having a profit before tax. Paid tax to get to profit after tax, paid a dividend to end up at retained earnings. The purpose of this video is to explore these costs, specifically the cost of sales or the cost of goods sold, and these expenses, and also the interest expense, to understand how we would classify them and to some extent how they behave in the business under certain circumstances. So let's move forward to a slightly simplified view of the income statement. And you'll see here I've added some descriptors, specifically referring to the cost of sales as a variable expense. And the expenses, that's the rent and the salaries, and let's call them the overhead, as the fixed expenses. So let's just pause with those two for a moment. I'm calling these cost of sales under this condition variable because in principle the cost of sales increases as your sales increases. Now we're making some assumptions here. We're assuming that we are producing some product that is manufactured, that has raw materials that go into it. And if you want to sell more goods, you have to produce more goods. And the cost of production, in essence, is represented by the cost of sales. So that's what makes this expense variable in nature, which suggests it changes in relation to the sales volumes that you sell. With the fixed expenses, these don't change. And the obvious example is management salaries should not increase in proportion to the sales volume. Normally they are a fixed expense for a period of time. And the same we could say goes for an expense like rent. So that brings us around to the interest expense. What type of expense is this? Does it change? Does it stay the same? And it's important that we identify what we measure this against. So interest expenses change in relation to an interest rate. They might also change in relation to the amount of debt on the balance sheet. But what's important to recognize with interest expenses is they don't change in relation to the sales or sales volume that takes place in a business. And because they're not linked to the sales volume, they are fixed expenses rather than variable expenses. The mistake that people often make around interest is that they assume that because the interest rate can change based on some external change in interest rates in the market, therefore this expense is variable. For something to be a variable expense, it must be linked to the volume of sales. Okay, so those are those key expenses, and that's the classification that we've given them. I'm going to take this income statement and I'm going to simplify it a little bit. I'm going to say, what if we could put this into a simple grid where we take these interest expenses and we roll them up, we include them with the other fixed expenses, and we create here a little simple grid that we're going to make use of when we put some numbers in it and we get things, and we get into some practice of using some of these income statements in some calculations. Let's have a look at a few different types of expenses that fit these different classifications. So I've put a definition in here where the fixed costs don't change as volume varies, provided you stay within your capacity. So that's an important piece there at the end, the piece about capacity, because if you significantly increase your capacity in order to take on a new project, well, invariably what that means is you might be renting more space, you might be employing more people, and then obviously your fixed costs will go up in order to meet the volume demands. But if you stay within your capacity, then I've listed a few typical examples of expenses that are fixed in nature: salaries and wages. Of course, this excludes any overtime. Rent, insurance. Insurance is based on the value of the assets, and we've learned now that interest expenses is based on the amount of debt. As far as variable costs are concerned, what we've learned is that these change based on volume, and it's normally in proportion to volume changes, which often shows up, or does show up mostly, in the sales that the business does. All right, so cost of goods sold is a variable expense. Often the commissions are variable. It's a percentage of sales. Royalties works on the same basis. And if we are getting someone else to transport our goods, we might pay them a rate per ton or rate per meter squared, however we measure our product. And the more we selling to our customer, the more we transporting, that makes that expense variable. Now that we understand the difference between fixed and variable costs, let's use some numbers to understand why this is so important in a business. So I have a grid here where I'm going to put in some details that describe 3 different business models. So the headings are here: variable expenses, semi-fixed expenses. Semi-fixed means some variable and some fixed. And here at the end, some fixed expenses. And let's explore these different business models and see what appears. So we're going to say in this business we do 1,000 rands worth of sales, and our variable costs are 920, and we have no fixed costs. So our total costs must be the sum of 920 and 0, and that obviously is 920. Now 1,000 rand minus the total costs of 920 gets us to a profit of 80 rand. So there's a very simple income statement, and it represents the fact that this business has variable costs only. Now, what if you have set yourself a sales target to achieve this 1,000 rands worth of sales? And what if you miss your sales target by 10%? For whatever reason, market conditions, one of your salespeople is ill, they don't make their sales target, and as a result, we only sold 900. Well, the nature of variable costs suggests that our variable costs will only be 828. That's obviously 10% less than the 920 that we were doing when we were selling 1,000. So now we're going to say our fixed costs are 0, that hasn't changed. And what is 900 less 828? That gets us our total costs. A total cost of 828. 900 minus 828, and there we get 72. So what's happened is our profit has gone down by 10%. Okay, that makes sense. What if we exceeded our sales target by 10% and we sold 1,100 units? Well, that's great news. But of course, to sell more units, you have to have more variable costs, cost to manufacture, and therefore we would expect that our profit would increase by 10%. All right, so this business is going to make 10% more profit when it does 10% more sales. So we would say that the profit and the sales are directly proportional. Now, if you were to think of a business example that fits this model, you'll battle to find anything, because there are very few businesses that have no fixed costs. If you have no fixed costs, it implies that you're not employing anyone, you're not occupying any space, and those sorts of businesses don't really exist. So this might just be an informal trader type of business model. Let's move on to something that's a little bit more realistic. And in this example, you'll see that we have variable costs and fixed costs. The sum of these costs come to 920, and 1,000 minus 920 gets you to 80. All right, so it's the same sales and same profit as our variable expense model. It's just a different combination of expenses. What if we miss our sales target by 10%? We have a lower manufacturing cost, but our fixed costs remain unchanged. So our total costs do come down a little bit, but now notice the drop in profitability. For a 10% drop in sales, we have resulted in a 60% decline in profitability. Now that's what's called operating leverage. That's what happens when your sales just drop off a little bit, but your profitability drops off significantly. And the reason for that is this introduction of fixed costs. So this represents the downside of this scenario. But of course there's an upside. What if you exceed your target by 10%? You will have higher variable costs. But if you haven't exceeded your capacity, then the fixed costs remain the same. And the result is our profitability increases by 60%. That's from 80 to 128. So during growing times, expansion, more sales, we have this growth in profitability. In our last scenario, here we have a business that has no variable costs. It is fixed costs only. So this business is typically a service business. It's a consulting type business. It's an accounting firm. It's a business that has a large number of people employed in order to deliver the service. And under these conditions, what if we miss our sales target by 10%? Well, of course our sales are down, but we have no reduction in the costs. So immediately you can see we are going to make a loss of 20 Rand here, which is effectively 125% decline in our profitability. So a very small drop in sales can cause this service business to go or make a loss, maybe go bankrupt, who knows, depends whether they have the cash to pay their employees. Of course, there's a tremendous upside. If we exceed our sales target by 10% to 1,100, then our fixed costs don't increase, provided we don't have to employ more people to achieve this additional sales. And what you see here is 125% increase in the profitability. So as you reflect on these numbers, just notice as we moved from right to left in our models here, look at the variance in the profitability. The variance got bigger and bigger. So from minus 10 to plus 10, all the way down here to minus 125, plus 125. That variance is actually a representation of the riskiness of the business. As we add more fixed costs to the business, the risk increases. And typically, those fixed costs come from employing more people and occupying more space. So something to think about that relates to the business model and the fixed and variable cost structure is here's a business that operates a type of hot air balloon, and it has a hanging basket below it, and it can take passengers up. It's fixed to a steel rope in the ground and a winch, and obviously this balloon can go up and down, and the views from the top are fantastic. And we want to consider the business model for this business. What are the variable costs? What are the fixed costs? How many passengers should we take at a time? What if one passenger rocks up? Should the balloon go up, or should we wait until we fill the basket? Those are some things to think about in the context of this business. And when we have our webinar, we will explore this in a little bit more detail to understand this business model. So that brings to a conclusion our discussion on cost behavior. We'll see you in the next video.